Hello and welcome to the course. I'm so glad you're with us. Hi, I'm Steve Ballinger. I'm the creator and the instructor for the course and a long-time successful investor, and I'm very glad you're with us here. As you can see, it's a very big course. We've got a lot of material to cover, which hopefully that's great for you. And the course is designed that you can start at the beginning and go all the way straight through, and it's in a logical manner, so you can do it that way. Or if you are, depending where in your investment journey, maybe you want to skip around to different sections or different lessons. That's perfectly okay. It works that way as well. Whatever works best for you. Though I would encourage you to watch the next two lessons first. They're kind of good foundational ones around can I make money in the stock market and how much, and then also looking at, well, what's the worst that could happen and what's a worst case scenario. So the two lessons that happen after this one are good foundational ones to watch, and maybe the whole purpose, they'll get you all excited about investing in the stock market. A couple other things to make sure how you can consume the course as best as possible for you in this quick introduction. One is you can change the speed. Udemy allows you to change the speed. They change your look every once in a while, but they'll always have a control as far as how to adjust the speed. So sometimes I get very excited talking about stocks, and I might talk a little fast for many of you. Feel free to slow it down, to change the speed down if you need to do that. Also, the video quality comes out automatically based on your internet connection and other things, your device, and Udemy takes care of that all automatically. But everything I filmed is in 1080p high definition video, so you can always adjust that as well. If you want, just Udemy automatically streams it to be at the best rate. Also, a couple things. Good to take notes. I would encourage you to take notes as you go through the course. Maybe you hear something, you're like, oh, I heard about this mutual fund expense ratio being above 1%. Might want to look at that. And maybe you're thinking, I have mutual funds. Maybe I want to check that. You just make a little note as far as some things you might want to check, or maybe you want to look at a link or something that's included in the course later. You can do that. So it's good to take notes as you go through the course. And lastly, ask questions. That's a beautiful thing about Udemy, is you can ask questions, and I answer every single question. And I encourage folks to ask questions. I encourage everyone in the course to jump in and answer questions and share their thoughts as well too. So click the button that says Q&A or questions at the top there, and feel free to ask questions. Once again, I answer every single one. Okay, well, that's it for this short intro. Let's get diving into the course now and learn how we can become great at investing in stocks in the stock market and make some good money along the way to fund our goals and dreams. Well, if I was taking a course on stock investing, probably the first question I would have is, hey, can I make money in stocks? And if so, how much? That would be pretty important to me, and I'm sure it is to you. And the good news is, yes, you can make money in stocks. In fact, stocks outperform things like bonds and cash and other asset categories, so they're a great way to grow your money. I suppose this is a pretty short and lousy class where you said, well, no, you can't. Since it's a good long course, yes, the good news is that you can. The key is historically you can make stocks. That doesn't necessarily mean you can in the future, or the past predicts the future, but we have over 100 years of information. So yeah, stocks can make money in the future here, I believe. Certainly over the long term, stocks make money. In the short term, they can be really risky or volatile, go up and down quickly, but over the long term, they do make money. And I'll show you some charts and things in a second here, and that shows that. And they do tend to go up, once again, over the long term. Individual stocks might go down and never recover, certainly, but if you have a diversified portfolio of stocks and apply some of the principles you're going to learn in the course here, you're going to be in a much better place than somebody who's just buying stocks without really much education. So historically they go up, there's a long-term investment, and they tend to go up over that long term. So how much? Let's take a look at some charts and some numbers so you get a feel for how the stock market kind of works as far as returns. This chart here just shows some historic market returns. Looking at the Dow Jones, it's a smaller basket of stocks. Only 30 of the largest U.S. company stocks are representative of a variety of industries. Been around since 1896, and I wanted to use this, though it's not truly representative. It really does follow the rest of the larger type of stock market generally. And as you can see over this chart, if you start over in the 1900s, stocks go up, and over the long term, as we get into today, you can see that stocks have gone up by following the upward motion of that chart the whole time. That's the good news. Now the challenging news. You can see there's some drop-offs in there, as it's not just a straight line going up. There are up and downs, peaks and valleys, and when it's going down, that means your investments, your stock has gone down. Maybe that's a great time to buy some new stocks, actually, as you're buying low with the idea of eventually selling high, right? Stock investing 101. If you look at here, like let's look at the end of 1929 here, right at the beginning of 1930. What happened then? All of a sudden stocks went plummeting. Well, that was the Great Depression, right? That was the Great Depression of the 30s, and you can see how the Great Depression stocks went down pretty quickly, very quickly. But they rebounded, and they overcame the Great Depression. They overcame World War II in the 40s, and they overcame all these things that are these obstacles to stocks and the world and challenges overall, and have continued to rise over a long period of time, outperforming things like bonds and cash and their peers. So long-term investment, it can be really, really good as far as investing in stocks. If we wanted to see how much return that would be, looking at this chart here, I pulled this out of Vanguard. Vanguard has some sample portfolio, so they did a more broader based look at stocks from a larger amount of stocks than just the Dow Jones, so they can give you a feel for average annual return over a long period of time. This is looking from 1926, right before the beginning of the Great Depression, happening in October 1929, all the way up to at least 2015. Not too far in the rear view mirror here for us. And this is a portfolio of 100% stocks, broad base of stocks. And you can see the average annual return is 10.1%. So somebody says, oh, the average return in stocks is 10%. That's kind of where they're getting that number from. It's not totally the total story on that, but it's at least a starting point number to say, yeah, it's not like 1 or 2%, or it's not keeping up with inflation. It well is. So you're looking at 10%, but that could be, it's been less in recent years, maybe more in other years. And you can see the range, the best year and the worst year. Best year overall stocks up 54%. Wow, hooray. Worst year down 43%. Oh my God, that's not fun at all, right? So you can see that broad range. And the interesting thing with that broad range, that's right in the middle of the 30s, right? You got the Great Depression, and stocks went way down, and then they went way back up, and they went down, and all that. You can see that was a very volatile time, and we got some volatility now, but not like that. Years with a loss. So this is saying that out of 90 years of investing in stocks over this 1926 to 2015 time period, 25 of those years you're going to have a loss. It might be only 1 or 2%. It might be as big as 40%. But 25 of the 90 times you're going to have a loss. The good news is the other times, the other 65 times, you've got a gain, or at least breaking even. You've got a gain, you don't have a loss. And so that's some good news as far as investing in stocks. If we looked at it by another chart here, just to give you a feel for it and get you comfortable with it, if we looked at stock market historical returns by decade, you can kind of see where they're at as far as that too. And you can see some of these early numbers here. They got the 10s, 1910s, 1920s, 1930s, all that. Even the 30s with the Great Depression, you can see at the end, if you start at the beginning and then at the end, you lost like 0.63. Yeah, it was 10 years of misery, but it wasn't like you were down 40% for a whole decade. And if you kept investing, you were buying low actually during that period. Then most recent times, you can see we have the 1980s and certainly the 1990s with the internet boom and bust. So you had that. You had the 2000s where it was pretty flat. That was kind of considered, kind of a flat time period. This is, once again, looking at overall stocks, more US-based stocks for this number, so overall, but worldwide, we'll file a little bit too, but just to give you a feel. And then more recent times, some better returns, but that can be up and down too as well. It's very, very recent type numbers. So the thing to take from this is that, yeah, there's going to be up times and there's going to be down times, but overall there's some up times. And particularly if you continue to invest and continue to take a portion of your income and invest it regularly in the stock market, you're going to do very, very well. In a broad diversification thing, I certainly advocate investing in things like bonds and a little bit in cash possibly, depends on your investing goals and all that. But you can see some returns here. Let's finish this lesson here with one other thing. We're going to do a demonstration here, and we're going to look at one other thing here as far as, well, what if I continue to invest in stocks, and how does my money grow over time? I mean, I'm taking on some risk. Yeah, the returns look pretty good. What will it look like in the future for me? So let's do a demonstration of that. And really where you go is you go to MoneyChimp, you go to moneychimp.com, go to Compound Interest Calculator, and you will find it. So let's go take a look at that and do some demonstrations. Okay, we're here in MoneyChimp.com. I think that's kind of a fun name, right? MoneyChimp.com. You can see in the upper right. We're in the Compound Interest Calculator. If you just go into their calculators or calculator / compound interest, you'll find it. It's a very simple calculator to show how your money grows over time. And we'll do a demonstration here with this, and you can go to this and play with it yourself and put in your own numbers based on maybe how much you have to invest in a particular time and how much returns and things you might expect. So let's say we start with 0, or we're going to walk through this different calculator, and it's going to tell us at the end what is our future value, what are we going to end up with after a certain time period. So let's walk through this real quick here. So let's say my current principal or money that I have right now is zero. I don't have anything invested at all. I have zero. And let's say that every year, annual addition, let's pick a number here. I'll use US dollars. I'm from US, so, bear with me. You could use rupees. You could use pounds. You could use euros, whatever your currency might be. But let's say we'll use dollars in this case. And let's say every year, let's say I'm doing well and I contribute $10,000 a year. Maybe it's less than that. Let's say I'm just doing let's do a little less. Let's say $6,000 a year savings and investing in the stock market, right? Once again, you adjust it a little higher, a little lower, whatever you want to do. And let's say we do this over 30 years, right? So if I start at 25, let's say that put me at 55 years old, not even 40 years, that might get me closer to a traditional retirement age. And as we saw in stocks that we could get, around a 10% return on a rate, maybe a little bit lower. Certainly we don't know what the near-term future is, so let's go real low. Let's say, we could get 7% on our stocks. We're not going to say 10 or 9. Let's be pretty conservative on it. And if we have an overall diversified portfolio of stocks and bonds and cash, we might even put a little bit lower number on that. But let's start with 7 just to see what it is. Make additions at the end of each period. So that means at the end of every year, you'd add $6,000. You could be investing every month too as well. That's actually a better strategy. But for the purposes of the calculation, here's our numbers. We start with nothing. We're investing $6,000 a year over 30 years, 7% annual return. Let's see what our number ends up at the end by investing if we can get a 7% return on our stock market portfolio. And you can see we're at $566,000. So, just by investing that every year and how it grows and compounds, we're over $500,000. If we let that grow to maybe a more full retirement age, so let's say 40 years, and as we got promoted and did things at work or in our careers and we were able to put away a little bit more, maybe we were able to do $9,000, still 7% interest, how would we do then? Wow, that's like $1.7 million. That's pretty good over a 40-year period. So you can see how stocks and things grow. Let's go back down to our 6,000 just over a longer period. And you can see even with 6,000 a year over a long period, 40 years, it'll grow and you're over almost $1.2 million. And if you're closer to your retirement age or you're closer to things, just adjust these numbers down. Maybe you need to put in a little bit more and take out less years to grow. The point of all this is that by investing in an asset class like stocks, which will be riskier but outgrow the market, you can see you can get some pretty good returns here over time, and that's what helps fund your future goals and your future dreams. So can you make money in the stock market? Yes. Now, is it risky? Yeah, and that's what we're going to talk about in the next lesson here, and we're going to look at the worst case scenario, and I think that'd be pretty interesting. Well, what's the worst that could happen? And that's coming up next. Okay, as we've seen over time, stocks can give us a pretty good return, maybe a great return, especially compared to inflation, especially over time, and especially as you use compounding and continue to add and continue to buy and let that money grow and compound over many years. There's actually Albert Einstein who said that compounding was the greatest discovery or the greatest phenomenon in the universe, which is interesting. He's the E equals MC squared guy, of course, and yet he recognized the benefits and the power of compounding. But stocks can go down too, and that's the risky part about it. And so we're going to take a look here. Well, what's the worst case, a worst case scenario? And at least what history tells us the worst case scenario was the Great Depression, right? Many, many years ago, and we actually have things in place now from governments and ways they get involved with monetary policy, adjusting interest rates up and down and things to try to prevent another Great Depression. But let's say that's the worst case scenario and it happened again. How could we survive that? Can we survive that? And what actually happened back in the past? So worst case scenario was the Great Depression and this big stock market crash. You might have heard of the stock market crash, and we're going to look at that. Otherwise known as Black Monday and Black Tuesday. And they weren't black because the numbers went up. They should have been maybe called Red Monday and Red Tuesday because the numbers went down, way down. The stock market crash went way down, worst of all time. And it was bad, really bad. How bad was it? Well, on Monday, the stocks went down, unexpectedly down 12.8%, almost 13% in one day. The entire market, one day, boom, down 13%. The next day, down 11.7%. 2 days in a row, down 11.7%, and then continued. So within 2 days, all of a sudden, 24% of returns of investments were gone. Think of that. A quarter of everybody's stock market portfolio gone, zero. Well, not zero, but gone 25%. in 2 days and how long that might take to make up for it. And we're going to do some interesting analysis here. I'm going to do a demonstration where you can kind of see, well, what was it like and how did the returns bounce back and how did people survive these worst case scenarios? And they actually did quite well. So we'll look at a couple of time periods of the Great Depression, 1929 to 1939, and 29 to 39 roughly, which was the beginning of World War II. Another big seismic traumatic thing in the world, right? World War II. And we'll see, well, what happened between, like, if I invested right, at the beginning of the Great Depression, maybe earlier in the year 1929 through the Great Depression, how did I do? And how about 1929 to 1945, 46 as far as World War II? And if that's the worst time, how did that end up looking for folks? So let's go ahead and take a look at that. And I'm going to go back to MoneyChimp as a nice little compound interest thing to really help us do that, because they can look back at historical market returns and you can do some what if scenarios yourself as well. Okay, I'm back here at MoneyChimp.com. This is /features market, dash CAGR. If you just search MoneyChimp compound annual growth rate, or CAGR, C-A-G-E-R, you'll find it too. Got the link there in the course as well. And you're looking for overall stock market returns. They have a CAGR where it's looking at future values, but we want to look at stock market returns historically is what we're going to look at. And we're going to do some date ranges and things and look at these worst case scenarios during the Great Depression and World War II. And CAGR, it basically stands for compound annual growth rate. So it's a different number than an average rate. You hear in averages, we looked at the first number was kind of average returns, things that in that portfolio number, we're looking at that 10% average, but actually CAGR looks at things going up and down, and so it's more compounded, and it gives you a little bit better actually number, but a smaller number. Actually, you're going to get a smaller return number if you do it from a compound annual growth rate, if you get real kind of geeky about it, I guess. But we don't have to worry about geeky things. We just want to look at returns over the years. And you can see on the left-hand side here, how they have the returns for every year. So if you're wondering, like, well, how was 2009? I heard that was a big bounce back from the the crash with the where the stock market went down 37% and bounced back up 27% during the Great Recession. A big dramatic time for us. But let's go in more recent history. But we're going to go back and we're going to look at the Great Depression, because we want to see. I want to know the risk here. I want to know what's the worst case scenario. So we'll look at the beginning here. I'm typing just the dates. Here's January 1st, 1929. So the beginning, the market crash happened in October. So there's a little bit of gains early there, but really that big crash wiped them all out. And we're going to go to 1939, the end of 1939. Towards the end of 39, of course, is when the World War II began. So this is really kind of covering that whole Depression decade. So I put in the dates. I'm going to include dividends, like we're reinvesting in dividends, and we're going to see what our return is, and we'll walk through this here real quick. So I hit calculate after I put my dates in, and we'll adjust for inflation in a second. I'll demonstrate that. But first, you can see the average return, even during the Great Depression, was 3.86. Now that's the average. That's not compounded, so a compounded number will be less. And that's where that annualized CAGR is, a negative return, because the stocks go up, but then they go down dramatically. It takes a little more to get, recapture those gains. So that compound annual number is a more conservative number. And you can see that's a negative 1.1%. All right. So even in the Great Compression, I'm not losing 30% every year. I lost 1%, but over a long period of time, over 10 years. Also, the standard deviation is a measure of risk. The bigger the number, the more volatile risk is. And 31% is huge risk. Lots of big swings during the Great Depression. So later in the course, we'll have some things around standard deviation and beta as far as measuring risk. And you'll learn all about that. It'll be real easy. But understand, this just showing this big number means that's really, really risky. And $1, if you invested $1 US, it would have grown to 89 cents based on the CAGR. Not grown at all. It means you would have lost money. Your investment would be worth 89 cents. And you can do the math if you had 10,000 or 100,000, how much less you'd have. But it's not the complete devastation that you might think of during the Great Depression, but it was for a long period of time. That's why holding stocks can be a more long-term game. Now, if we adjust for inflation, because something unusual happened, because think about the Great Depression, where prices, which is inflation means prices are rising in goods and services, were prices rising? Was it more expensive to buy something? And actually no, because think about it, all these people are out of work, the stock market's been crashing, so if we adjust for inflation, let's see what happens here, and we just calculate, we actually get a better return in comparison adjusting for inflation because prices went down, or deflation. So actually, even though my return was negative, when we saw it without inflation, now our return is actually a little bit positive. And our dollar, in effect, comparing inflation, actually grew a little bit because of the pricing pressure of this very devastating time. And you can see that here. Now let's play this out further. Let's say, well, we're a long-term investor. We invested at the great stock market crash, which we're not. This is just truly for academic, so you can see worst case scenario because it's so much better now, but we want to look back at the past as well. And let's say we go up to 1946, right? Right past the end of World War II. We took out the inflation measure. We're adjusting for our dividends. And what happens? We started in 1929 and we went to 1946. What was our return over that time period? You can see it's pretty low, right? It's still, well, 6.49, that's not so bad average, but our CAGR, our adjusted returns 2.77, not the end of the world, but not negative either. Remember, this is the Great Depression and World War II, and looking over the stock market over a period of time, still high standard deviation, but our dollar grew as well. So even during like a worse period, and I'll show a better period here so we can see, and if we adjust for inflation, actually something unique happens here, or it should, yeah, where it went down, our overall annualized return went down, and our actual dollar grew less because we had prices start to come back as there was a recovery, right? So you can see even during these worst periods of time, over 2 decades, almost 2 decades of the Great Depression and World War II, in effect, my purchasing power and my return grew over that time. And you can have fun with this and play with it during different time periods. I mean, if we were to have fun and look at, let's say, 1990 to the year 2000. Let's say 1998, you'll see some crazy numbers because that was during the time of the dot-com boom where the technology stocks took off because of the internet, there's new technology. You can see 18% and our dollar grew just dramatically. So you can see how you can have that and then how the bubble can burst as well. So really the thing to take away from all of this is understand that your investments can grow over time. But there might be some ups and downs with it. But even worst case scenario, at least my feeling on it is you're going to be okay in the stock market, but it's got to be over long periods of time. You can't sell right when the stock market crashed over 2 days and went down 30%. You need to kind of stay with it and either continue to invest. And that's the other secret sauce on this too, is when we saw that Money Chimp thing looking at compound interest, this is not calculating in if I kept buying on a regular basis, because then as I'm buying low, it's actually going to grow even more over time. And if we look at this last chart here of the stock market history returns by decade, you can kind of see how the decades played out. This is the average number, but you can see some of these big numbers and some of these small numbers as well. All right, so this is great. So the good news is, yes, you can make money in the stock market. Yes, it's risky, but if you do it over time and if you continually to invest, you're going to be in pretty good shape. And that's been certainly a secret of mine, not really a secret, it's pretty well known among investors, that continually investing, automating your investments, and continuing to educate yourself, and what we're going to do in the rest of the course, and making better choices in our stocks, our stock mutual funds, and exchange traded funds, is going to really help us to be successful over the long term.